hi everyone. I'm Debbie Schwartz, founder of Road to College and the Paying for College 101 group. I'm here tonight with Angela Colatriano. She's the Chief Marketing Officer at College Ave Student Loans. I am going to just spotlight myself and Angela so that if it makes it a little easier to see us. And great. I'd love if people can just say in chat, where they're from, what year their students are in high school. I'm assuming majority of the people on tonight, you have a student who is graduating high school, so congratulations, and you're figuring out, how to pay the bill and hopefully go to high school graduation and figuring everything out as they transition to freshman year. But if anybody here with a younger student, I think that's fabulous too, because it's really good to understand the loans and the whole loan process even before you really get involved with the meat of the admissions process. So kudos to you if you're here and you have a younger student. Let me just tell you how tonight's going to run, and then we'll truly get started. So this is a meeting. If you guys come to a lot of my sessions, I like to do these as meetings. I like to be able to see people's faces, whoever wants to put themselves on video. Thank you, and nice to see you, but you don't have to. And then the other value of doing a meeting is that if you want to unmute yourself and ask a question, that's great too. You can do that. You can also send your questions in chat. The other thing is that we have some slides tonight along with the discussion I'm going to have with Angela. And we're also going to share, and this is recorded, that's always a question, and you'll get the link tomorrow. But we also created what we're calling a tip sheet, which is a summary of really the important things that you need to understand from tonight's conversation, and we're going to send that out tomorrow. So the purpose of all of this is that you can be a little bit more relaxed listening to what we're going to talk about tonight. You don't have to feel like you have to take notes. You can, absorb it. You can go back and watch the recording. We're going to send you basically a summary of notes. So just, listen as much as you can, ask questions, and hopefully, things will sink in. And if you still have more questions, you can always come back and ask at a later point. So let's get started. Thanks, Angela, for being here tonight. It's always great to do these. We've been doing them for a few years now.
We have. I'm thrilled to be here, Debbie.
Let me share this slide so that we can get started that way. And yep. And if people can just give me a thumbs up, do you see the slides? Yes, thank you. Okay. Okay, we are ready. So as I mentioned, I'm here tonight with Angela Colatriano of College Ave Student Loans. We've been doing this for a few years, and I partner with College Ave on a few different types of activities, but I love doing these sessions because College Ave is really devoted to educating families, because that's a really big, important part of this process. A lot of you have already been through kind of a tumultuous process of the admissions journey of dealing with applications and testing or not testing and essays, and then making a decision about where your student's finally going to go to college. And now, quite honestly, you have another little mini process, and that's the process of figuring out, how to pay for it, and if you're going to take out loans and where to take out loans. So I love that, College Ave is willing to spend the time and the effort to help me educate you guys on this next phase of the process. And it's really not something you should be nervous about. It's just learning a little bit more and doing a little bit more research, and then you guys are like almost there at the finish line, sending your kids off to college in the fall. But I'd love, Angela, if you want to tell us a little bit about yourself and a little bit about College Ave, and then we can talk a little bit more about the details of student loans.
Sure, absolutely. I will be brief because I know everybody's interested in jumping into the content. Really just want to tell folks that, we are a private lender. We're going to go into that tonight, defining exactly what that means and what we offer. But we built our business, Debbie, I'm not sure you could have done the introduction any better. We built our business really because We believe in the value of higher education, but we know what a major financial investment it is. And we're really committed to trying to take as much of the stress out of that process as much as we possibly can through the information, the tools, and then ultimately the products that we offer. So, we want to offer people all the information to make the best choices for them.
Great. So actually, and along these lines, and we've been promoting this in the Paying for College 101 group and in our newsletter, but I'm just going to put this in chat as well. That College Ave has been doing a sweepstakes, which we started in the middle of April. It's going to go to the middle of June, but there's actually 2 halves to the sweepstakes, and they just pulled some winners, which I think we are going to announce this week. So that's fun. And, if you guys want to throw your hat into the ring, and you still can, and there'll be some other prizes that will be picked the middle of June. And these are all good prizes to help your student, get them to college. So hopefully you'll want to do that as well. Okay, so tonight, as Angela said, we're going to talk about loans. We're going to talk a little bit about the FAFSA and how it relates to student loans, federal loans, and the difference between the federal and private loans, and then get a little bit more detail on private loans and the features of private loans and the features you should really be most concerned about, and how you should go about researching those features. So let's begin with the FAFSA, Angela, and maybe explain why the FAFSA is important to student loans. Like, I think when people are thinking initially about the FAFSA, all they're thinking about is it's going to calculate my EFC, or at least that's what we try and teach everyone about, and they don't necessarily always make the connection to loans.
Sure. Yeah, I always think of the FAFSA as the way to raise your hand and say that you want to be considered for any aid. And when I say any aid, I mean federal student loans, work-study programs, state grants, money or discounts from the school. And frankly, some schools will even use the fact that you've submitted the FAFSA as a sort of a gating mechanism on whether or not they consider you for merit aid. So it just all starts with the FAFSA, and then what you get from there will determine if you need to borrow, and then it will be that gateway for you to the federal loans. And then from there, you can make additional choices about borrowing, but it all starts with the FAFSA. You always want to complete it every year that your student is in school, and it's always better to do it as early as you can when it comes out in October, because some of that aid is first come, first served.
But what about if people, and they might have purposely decided that they know they're not going to get need-based aid, so they didn't fill it out in October, and that's fine, and it wasn't part of the admissions process. Should they fill it out now, because they might realize, well, I want my student to take out loans, or I need them to take out loans?
It's never too late. It's always better to be early, but it's never too late is what I would say. And absolutely, if you haven't done it yet, complete the FAFSA. And then if you need to work with your financial aid office to ensure that they receive that, do so. But it's always a good idea to fill this form out.
So the other thing I'm just going to emphasize is related to the FAFSA before we move on. It needs to be filled out if your student is going to take out any federal student loans, and we'll talk about the federal student loans and why those are important to look at first. But you also need to fill out the FAFSA if you as a parent are going to consider the Parent Plus loan. So any money coming from the government, you won't get any of the money unless you filled out the FAFSA. So that's again why it's so important to understand that. Okay, so assuming people have filled out the FAFSA, they may have already gotten some of this information in financial aid award information, but there are 2 types of, there's one overarching federal student loan, and then it's kind of broken up into 2 types of loans. Do you want to, can you describe a little bit the difference between what the subsidized and the unsubsidized loans are?
Sure. So I'm actually going to start on the unsubsidized side, because that is the most common. And there's a few things that I want to make sure that people understand. I think this circles back even to that fill out the FAFSA comment. Really, virtually every student is going to be eligible for a direct unsubsidized loan. It is not need-based. It is not based on how much income your family makes. The only thing we occasionally see on the unsubsidized loans that may surprise people in terms of eligibility is that the student does need to be enrolled at least half time. But as long as they're enrolled at least half time in an eligible university, which is, I would guarantee probably virtually everybody who's on here, your school is your students at an eligible university, they can access those unsubsidized loans. And in the case of those loans, what the difference is really between these two is when the interest starts being charged. So on the unsubsidized loans, the interest is going to start to be charged on those loans and start to accrue on those loans when the money is sent to the school. And on the subsidized side, the only difference here is that there is a need component to this. So the family's income and financial situation will factor into whether or not the subsidized loan can be qualified for. And if you do qualify for the subsidized loan, the interest will not be charged while the student is in school. The interest will only start accruing on a subsidized loan once the student leaves school and enters the repayment period of the loan. That's when that loan is going to that's when interest is going to start being charged on the subsidized loan.
And I get a question a lot of times from families where the student maybe at one school got some subsidized loan and then at a different school they weren't offered a subsidized loan. So why would that be the case where it would be different from one school versus another?
So that's where it comes back to the school and them factoring in multiple things. So they are partially factoring in the family's financial situation, but they're also looking at what that student's costs are at that school. So it's the easiest way to say it is that it is an individual school decision, and you can't anticipate that you're going to get the same offer from every single school from that standpoint. The other important thing to understand as well is that I don't want to jump ahead to the loan limits, but there are lower loan limits for the subsidized loans than there are for the unsubsidized. So the subsidized portion can only make up a smaller amount that you can qualify for in the total unsubsidized loan.
But the important takeaway here for everybody is that regardless of your income, as long as you fill out the FAFSA, your student is eligible for a direct unsubsidized loan. And we're going to show what the limits are, but anybody, any student can take out that loan. And I guess actually before we move on, the other important things to talk about these loans are whose name is it really in? Is there a co-signer? When do they need to start being repaid? All that information, because that's really important for people to understand. And it's the reason why they should be looked at first.
It is. So these loans are directly in the student's name. They are only in the student's name. They do not require a co-signer. The parent is not legally responsible to repay these loans. And they do also tend to have the lowest fixed interest rates available. They're going to have income-based repayment options and other protections for the student. So this is always where you want to start, which is, again, why you want to fill out the FAFSA, because if you're going to need to borrow, or if you think there's even a chance you'll need to borrow, these direct federal loans are always the place you're going to start.
And to that point, and again, a lot of people watching probably haven't started doing research on loans yet, which is okay, but it's not honestly going to be feasible that a student can get a loan without a co-signer other than this federal direct student loan. So that's why it's really important. And if there's any sort of borrowing that the family needs to do, the student should absolutely take out this loan as the first place that they're going to borrow before looking at other sources.
That's right.
Okay, so there are limits each year. Maybe you can explain a little bit more.
Sure. So this is why when people think or talk about borrowing for college, it often is not just one answer. It's not one loan. This is the place you start, and then we'll talk about what the other options are. And the reason this is the place you start versus where possibly you finish is because there are these annual and lifetime caps, but really the annual caps are the most important. So I'm going to focus more on the dependent undergraduate column to speak to, because that's just the most common situation. And you can see that as a freshman, you can take out up to $5,500. Now, the only reason why you might not be able to take out $5,500 would be if the school looks at your cost of attendance and maybe the aid that they've given you, and they say, well, you just don't need any more money. or why they might say you only need $3,000 or something to that effect. But what you would often see in a package is that you're often going to see that full amount available as a freshman student, that $5,500. And then it will step up sophomore year. So sophomore year, they'll be eligible for up to $6,500. And then junior year and senior year, it flattens out at $7,500 each year. And then there is that lifetime max of $31,000. And then you do have the independent side, which I would really stress that if you're interested in that very unique scenario, it is somewhat challenging to qualify as an independent undergraduate for this program. So I would visit studentaid.gov. That is the federal website that has all of the details you could want on all these programs for the really specific information about what would have to happen for a student to qualify for that.
If you can maybe also talk a little bit about the interest rates and you know, they just, the new interest rates kind of unofficially but officially just are being discussed, and what those numbers mean and if they change annually.
Sure. So the rates on these loans are fixed, meaning once you take the loan, the rate is not going to change. You're going to have that rate on the loan for the life of the loan. But that said, they determined what that fixed rate is going to be for that current academic year. It gets determined every May. And then that goes into effect July 1st. So the one thing to be sort of aware of if you are looking at the federal website is that they usually don't post these upcoming rates until you get a little bit closer to July 1st. So just make sure that if you're looking at the rates on the federal website that you're looking at, you know what you're looking at, and you know if you're looking at the rates that are going to be charged for the upcoming academic year or what is being charged for loans that are going out the door right now. And so based on the rate that got set with the Treasury sale in May, it looks like it's going to be just under 5% for the direct loans, for the fixed interest rate for direct loans starting on July 1st.
So there's a question here that maybe we should clarify. Somebody's asking if this slide and maybe also the interest rates that you just talked about are referring to the subsidized loans. And we didn't really, maybe you can talk a little bit, we didn't break out this 5,500 and how it's split, but maybe, you know, we could talk a little bit that there are two different buckets.
Yes, I can at least give you the example for freshmen. I don't exactly trust my memory beyond that, but I'm positive about the freshman number. Mm-hmm. So if you look at that $5,500, what that is really is a dependent undergraduate in direct loans, and then up to $3,500 of that $5,500 could be subsidized if you meet the requirements at that specific school to receive a subsidized loan. So it's really, the subsidized limit is a subset of that overall direct limit.
And the interest rate applies, it's the same interest rate in theory, whether it's subsidized or unsubsidized. It's just, if it's subsidized, and that the government's really paying your interest while you're in school.
Yes, it's just a matter of when the interest is begins getting charged. It's not a difference in the rate that you're going to receive.
And somebody had a question a little earlier about that they didn't see any of this information on their students' financial aid award letter. So there wasn't any information related to the subsidized or the unsubsidized loan, and they're wondering if they're still eligible for it. And so, I mean,
I'll give you sort of maybe three different pieces of what that answer could be, and a few different avenues to explore there. Mm-hmm. One is I would make sure that you're very clear on the way that the letter is set up, and that it's actually, sometimes there are loans that are included as line items in the award letter, which you may not realize is a loan. So the first thing I would do is go back to the award letter and make sure that you're very clear on what each of those line items are, and make sure that one of those is not a loan. If you confirmed that, then I think the second piece would be making sure, did you fill out the FAFSA, and then contacting the financial aid office to ensure that they know you filled out the FAFSA, and discussing with them at that point why a loan, you know, is not listed on there, and if that is a possibility. But those are the first avenues I would pursue, because in theory, again, assuming that you do have a cost that you need to cover, I would anticipate that would be available.
There's a few questions here about if students take out the federal loans, can they pay them off early? Is there any penalty to paying them off early?
No, there is no penalty to paying them off early. And that is, I will just say on the private side, that is typically the answer on the private side too. I always caveat, check with your individual lender, but by and large on student loans, there are no prepayment penalties. There are typically no penalties for that. And on federal, there definitely are not.
So another important point I think we should make is maybe explain, you've explained the annual limits, but what happens if I didn't take out the loan for freshman year and it's now sophomore year? Can I go back and take out the $5,500 I didn't initially take out?
That's a really important point, because this is one of those, like, you do have to stop and think a little bit about all 4 years, even though, you know, you're usually making your very specific decisions about that year that's right in front of you, but you do have to think a little bit about the long term, because if you decide not to take the $5,500 freshman year and you get to sophomore year and you say, oh, I could really use $10,000 this year, you still can only take $6,500. You can't go back sophomore year. You can't double up. You can't take your freshman loan sophomore year and get extra money sophomore year. You could possibly borrow, you know, you could have a 6th year where you're able to still access $7,500 in that 6th year, as long as you're within your lifetime max, but you can't go back and access that freshman money. You can't add it to your sophomore loan. You can't add it to your junior loan. So that's why you have to think a little bit about what your paying plans are going to be each year, because it might make sense for you to take that $5,500 loan freshman year, so, and then spread other assets that you have out, or other savings that you have, that type of thing, out.
And honestly, to combine the recent questions and answers, it's really important to look at the 4-year plan of how you're going to pay for college, not just this upcoming year, for all the things that Angela is talking about, because you can't go back and take the loan amount if you chose not to do it the first year or the second year. And if you did take the loan in freshman year and it's, you know, things are going well, and, you know, and you realize you have enough funds and maybe you didn't have to, you can actually always go back and pay it off early.
That's exactly right.
Yeah. So it's quite honestly, if you have any concerns or not even maybe knowing what the next 4 years would be like, it's kind of on the smarter side to take that loan. And then if things work out better for you, you know, go back and pay it off. But you know, just knowing that once the year passes, you can't go back and recoup that loan.
Mm-hmm.
Okay. So the other federal loan is the Parent Plus loan. You want to tell us a little bit more about what that loan is and how it differs from the federal direct loans we just talked about?
Sure. So just to kind of reiterate for folks, so the reason we always recommend starting with those direct loans is because they are in the student's name. But of course, $5,500 may not cover the bill that you need to pay for freshman year. So that limitation then may send you to look for other ways to continue to cover the rest of the cost. Parent Plus is one of those next, okay, then what? That's one of those options. And to your point, Debbie, that is another federal program. It is very restrictive in terms of who can take it. So it really does need to be parents. There are a few specifics around adoptive parents, that type of thing, but it really needs to be a parent of an undergraduate student who's enrolled at least half time. The parent is taking on full responsibility for that loan, and the parent is going to be legally responsible for repaying that loan. And so it's important to understand that you're taking that all on completely, and it is not them.
And so, yeah, that's why we kind of like to emphasize, and I don't know if you're kind of noticing the structure of how we're talking about these things. We're kind of, you know, starting off with the federal loans, the direct student loans, which we really, anybody in this space is going to encourage a student to borrow there first. And then if you still need to borrow after your student takes the federal direct loans, then there is the question about, do you consider the Parent Plus loan, or do you consider other sources? And we'll talk about private loans. But to even make the comparison, you need to understand what the Parent Plus loan is about. And the big factor to understand is that it is in a parent's name versus that federal direct loan, which is in the student's name.
Yes. And it also has a higher interest rate than the direct loans that are in the student's name. It has a higher origination fee, which we'll talk a little bit more about what that is. But essentially, the Parent Plus loan costs significantly more than the direct loan that is in the student name. And so that's why once you get to that point, you want to start thinking about other options.
So maybe you can explain and talk about the
Mhm.
interest rate on the Parent Plus loan, and is it the same for everybody? Does it vary? And a little bit maybe about the origination fee, and how it works.
So it doesn't, it is the same for everyone. So everyone's going to get the same rate. It is unlike a private loan, which is going to have different rates depending on your credit profile. The Plus loan is going to have one rate that's going to be available to everyone. And it's around 7.5% for next year. And then it does have the origination fee is just over 4%. Debbie has the details on the screen for you. And that origination fee gets added. It's a portion of the loan. So it's actually added into the loan. And so you also do pay interest on the fee amount, which can start to matter if you're looking at high dollar amounts for Parent Plus. So you do want to keep that fee in mind, not just for the initial cost, but also for the multiplication of the interest that you're paying on top of it. I know I saw a few questions around need. Is it need-based, and how do you qualify in those types of things on Plus? So it's not need-based in the sense that they are not looking, it's not like the subsidized loan. They're not looking at the family's income and deciding whether or not you qualify for a Plus loan. If you still have costs at the school to cover and you've maxed out the direct loans in the student's name, then you could be considered for a Plus loan. There will be a credit check, but it is a very basic credit check. There's no minimum FICO. They're not looking for anything detailed along that line. They're really just looking to make sure that there are no significant delinquencies on the credit report. And they're also looking for any existing federal loans that are in that person's name. So if that parent had their own federal student loan, or that parent took a federal student loan for a different child and had trouble repaying that loan, then that would be a reason why someone would not qualify for a Plus loan. So there is a basic credit check, but that's going to look very different than a private loan.
And I don't have the numbers, but really the majority of people get approved for the Parent Plus loan. It's just a small percentage of people who get denied.
That's right.
And there's a question here I just wanted to address. Well, two things about the origination fee. One, and just like to give you an example, if you're borrowing $1,000 and there's like a 4.2% origination fee, what that means is that full $1,000, it's going to be reduced, by the whatever, I guess the 42 or $4.22. So you're really getting slightly less of what's going to go towards the loan. I only say that for people's numbers. If they're really trying to calculate out, they kind of say, oh, but I thought I borrowed $10,000, but the $10,000 didn't get applied to the bill. That's because the origination fee was taken out and the net was applied to the bill.
It can surprise people sometimes with a little bit of a leftover balance or that type of thing, because they didn't realize that fee was going to take up a portion of the loan.
Right. So that's one thing. The second thing is I saw a question and I don't have the full math, but somebody basically, it looks like you're adding the 7.54%, which is the interest rate plus the origination fee, and asking if the overall rate is over 10%. That's not how it works. It becomes a blended rate. And usually it does probably, if you looked at the effective rate, it's probably going to be over 8%, but you don't add the two interest rates together.
That's right. And I believe there are calculators online that would help you do that math if you would like to do that.
Okay, so let's go on now to your other option besides the Parent Plus loan is to look at private loans, and we want you to understand what private loans are about and how they compare to the federal options that we just talked about. So maybe you can, Angela, talk about first what a private student loan is, and that people might not even be aware that there are things such as a private parent loan.
Sure. So before we even go to that, I just want to reinforce why are we talking about this now in the course of this conversation? So once you get to the point where you're considering a Plus loan, for all of those reasons that we just discussed, the fact that there is only one interest rate. So if you have a better credit profile, you're not going to benefit from that better credit profile on the plus loan. You're going to get the rate that is the rate, and you're going to pay the origination fee. So once you reach that point, that's why we introduce private loans into the conversation, because that's where it can make sense to start to explore all of your options. And there's a few reasons why we see people, or a few things we see people weigh when they're considering whether or not to go plus or private. And then I'll go into these private details, but I think this context is really helpful. So one is, do you want the debt to be only in your name, or do you want to share responsibility with the student? That's a big reason why people decide, I don't want to borrow plus. I would rather at least co-sign the private student loan, because I'm sharing that responsibility with the student versus taking on all of the responsibility on my own. So that's one gating factor that we see for people. The other piece is what I just mentioned in terms of, can you get a better interest rate in the private market? Or even if you got a roughly similar interest rate, but you didn't have to pay an origination fee, would that be a better deal for you? So that's usually why, when you get into, you've maxed out your direct loans, you're thinking about plus, that's when private needs to at least come into the conversation so you can decide whether or not it's an option for you. So now let's talk private student loans, and then I'll go to private parent loans. So private student loans are in the name of the student. The student is a responsible party on the loan, but they usually don't have a sufficient credit history or enough current income for a private lender to be able to make a loan to them. A private lender needs to be able to look at a loan that they make and say, if this had to be repaid tomorrow, could this individual that I'm making this loan to, could they repay it? And you often can't look at a student and say that their credit profile or their current income would meet those requirements. So they typically need to have a co-signer with them. It's often a parent. It doesn't have to be. It can be another credit-worthy adult, an aunt, an uncle, a grandparent, somebody who is invested in that student's future and understands the responsibility that they are taking on from a financial standpoint. They do, much like the plus loan, they will allow you to borrow up to that full cost of attendance. So you can cover that remaining gap up to what the school calculates as your cost of attendance with these loans. The interest rate is going to vary. So it is going to be based on your individual credit profile. Better credit, lower interest rates. And there's actually a few other choices you can make, which specifically with College Ave that can also help you get a better rate, but we'll talk about those later. They typically don't have origination fees. So always double check. It's always a good thing to confirm that the lender you're going with does not have origination fees, but I can tell you that none of the major issuers that I'm aware of have origination fees at this point in the private space. And then what's really important here, though, if this is feeling like this might work for you, and it is going to be you and the student together, you both need to understand that you are in it together. You do technically, legally, you are sharing responsibility. And so you need to talk about who's going to be responsible for the repayment, what your expectations are. Are you expecting to help repay it? Are you co-signing so that they can get approved, but you're expecting the student to pay the entire loan? Those discussions need to be had so that you're on the same page, but you also have to recognize that you are taking that responsibility either way. It is going to show in your credit report. Positive or negative payments are going to affect both of you positively or negatively. And so everybody just needs to understand the commitment that's being made and then be on the same page with what the expectations are.
And can I just add to that? I mean, I'm kind of jumping backwards a little bit. Even on the Parent Plus loan, there's a lot of stories that, people have reached out to me about where they said, okay, I'm going to take the Parent Plus loan and my child's going to help pay, when they graduate and they get a job. And that, works out in most cases, but sometimes it doesn't. And even though there was this expectation that the student was going to pay, the Parent Plus loan is in your name. And if they don't, there's nobody to go after except for you. So they're not always pleasant conversations to have, but they're important conversations to have. And you can have that conversation. And then there's also the legality of whatever it is that you're contracting into. And so in the Parent Plus loan, you are solely going to be responsible. On a private student loan, you're still going to be responsible, but your student is also on the hook as well.
And the one other piece that we should mention there is, student loans are a very unique animal in terms of credit products, in that Some do offer a cosigner release. College Ave does offer a cosigner release because we recognize that the cosigner is often in there in the beginning to help the student get through school, get the utility of the degree, and then get on their feet to be able to actually repay that loan, because the loan was designed to get the student the benefit, the economic benefit of that degree. So there are certain hurdles that will need to be met. Every lender, some lenders don't offer it at all. And every lender can have their own policy about what you need to do in order to be released. Our policy is on our website. I would recommend, if you're interested, go there for the details. But if that is something that you think you might be interested in, if that matters to you, make sure that you evaluate that during your shopping process.
Right, because it's going to vary lender to lender. And just like in, researching and shopping for any major purchase, you really need to understand the details of all the features and how it varies from, in this case, lender to lender.
That's right. So if we think about private parent loans are a bit more comparable, I would say, to PLUS, in that they're in the name of a creditworthy adult. They're called parent loans because that is the most common scenario, that it is the parent taking that loan, but it is less restrictive on the private side than it is on the federal side. So if you did have an aunt who would really like to take on responsibility for the student's education, they could take a private parent loan. The point is that the student is not on that loan. The student is not legally responsible for that loan. And again, you could borrow up to the cost of attendance, no origination fees, and they are going to have credit-based rates. So your credit is going to influence what interest rate you receive on the private parent loan side.
And that's actually like one of the most important things you said, to get a credit-based interest rate. And that's the big difference, what's happening in the private market versus what the federal government is offering for Parent Plus loans. For Parent Plus loans, they are just basically coming up with this one rate that is covering people who have really bad credit and who have great credit. And to tell you the truth, the people who have great credit kind of get a little bit mushed in that, because the rate is really covering the people who have not so good credit. Because if you have better credit, you can go out to the private market and get a better rate.
That's right. That's right.
There's a good question here. There's a lot of good questions. And if we don't get them tonight, I usually do a follow-up email with trying to answer some of these questions. But there's a good question that asking about each year, and maybe you can talk about this. Can you, actually the words were, roll. When somebody's asking, I thought, can you roll your loans together? Because, and how does it work that each year you might have, you taking out these loans? Are they separate loans, or do they all come at the end to be one big loan? Like, how does that work?
So different lenders are going to have different processes, but the short answer to that is you're going to have to come back either every semester or every academic year in some way to raise your hand and borrow again. And the reason for that is because every time you borrow additional money for school, it needs to go to the college to have them confirm, yes, the student is enrolled. Yes, the student needs these funds. And I do just want to hit one thing. I know I saw a question on cost of attendance that might be relevant here, because part of the reason you have to come back every year and go through the process with the school is that they validate that the loan is not going to exceed their cost of attendance. Cost of attendance does include tuition, it includes fees, it includes room and board or comparable funds for them to live off campus. But essentially think of it as room and board, whether that be on campus or off campus. There's usually some transportation allowance, that type of thing. They have a formula that does go above and beyond tuition and fees to account for those expenses that sit outside of tuition and fees. And all of that goes into cost of attendance. So yes, you need to come back either every academic year or every semester, depending on how you elect to borrow, so that the additional funds that you want can go through the process with the school.
So maybe to that point, that families have to come back every time. Are they getting the same interest rate, or does that going to vary year to year?
It's typically going to vary year to year. So what most providers do is if you're borrowing from the same lender, so let's just say you're coming back to College Ave every year to take out your loan for that next academic year. we do make it very easy, even though these are multiple loans, we do make it very easy from a servicing perspective to see, okay, but this is the total monthly payment, and you're going to have one due date. We're not going to have 4 different due dates for those 4 loans. So if you're working with one lender, they're going to do things for you that are going to make them look more combined than they are on the statement and from a due date standpoint and all those things. So they will try to make it easier when you are in repayment and servicing those loans.
There's a question about interest rates between the private student loan and the private parent loan.
Yes.
Do they end up being the same? Or if a parent and a student applied for the private student loan and then just the parent applied for the parent loan, any sense of how those interest rates might differ or not?
You really have to think of them as 2 different animals. So they may be, it's going to depend on each individual application. So somebody might apply for them and say, I got a fairly similar rate on both. But you may actually find that you have different rates on them. And the reason for that is because on the student loan, you have 2 individuals. So we're looking at the credit profile and the income for 2 individuals on the student side versus on the parent side, you're only looking at one person's profile. So sometimes that can help, sometimes that can hurt. It might depend on your student's credit profile and whether or not that helps to have 2 people on or not. So they could be very similar. You will often see that the ranges in terms of the low end and the high end and the possible ranges are often, I would say, relatively similar, but the actual rate that you get if you were to apply for both could be different. And it really is just going to depend on who's applying.
Okay, so let's move a little bit on to credit and also pre-qualification. And maybe if you can talk about what pre-qualification is, and then by applying to all these loans, is there an impact to the student and the parent's credit?
Yes. So from a pre-qualification standpoint, usually when we talk about pre-qualification, what it means is that a lender is going to do a soft inquiry on your credit bureau to give you an idea of whether you can be approved and possibly what type of interest rate you might be able to expect. It's not a full application. It's not a guarantee, but it does give you a better idea of where you may fall with that lender. It's a great shopping tool. And the benefit of that is that soft inquiry does not impact your credit score. So you can shop a little bit, you can get a bit of an idea without actually affecting your credit score. And then when you get to the point, that might help you narrow it down. If you're out and you're shopping and you're using pre-qualification tools, and maybe you narrow it down to who you think are your top providers that are going to be the best fit for you, you can limit how many places you actually apply when you go to get your loan, how many inquiries get applied to your credit bureau. And the other tip around shopping, when you do go to actually apply, submit a full application where they're going to do a hard inquiry on your credit report, do all that shopping within 30 days. That typically happens with student loans anyway, just because most people wait until they have that bill and they know exactly how much money they need. So it tends to be a condensed shopping window for student loans anyway, but you do want to do it within 30 days, because if you do it within 30 days, the bureau recognizes what you're doing. They understand you're shopping for a particular type of product. They see, oh, they're not just shopping for many types of credit. They're shopping for the best student loan for them. So as long as it's within a 30-day window, it will limit the impact that has on your credit score.
So, I mean, the bottom line is, if you're starting to, understand what student loans are about now, and you have no idea really, what interest rate you might get, there's no harm in starting tonight to this weekend in doing a pre-qualification, at multiple lenders, to see what that pre-qualified rate will be. Again, it's not a guarantee, but it's kind of a ballpark of where you might end up. And then it also helps you narrow down who the final lenders are that you might put in an application to, where they're going to do a hard credit pull.
That's right.
So there was a question earlier about taking out a private student loan and their student paying it back, and how the paying back might help building a student's credit.
So certainly positive payment activity is going to help build credit. So the fact that the loan is on their bureau and then there's positive repayment behavior, that is absolutely going to build positive credit. The one thing I would caution people is if you take one loan freshman year and let's say you start making payments right away and you have a year of positive payments, sometimes people think then by sophomore year, oh, well, now they have a credit report and they have positive behavior. That's not enough for them to get approved on their own with a private lender. It may help because their profile will look better, but it's probably not enough for them to borrow on their own. But the important thing to understand there is that it builds your credit, but it builds it in a positive way only if those positive
Are on time.
payments are getting made.
Right. So I don't know how much detail you can go into about this. So, you'll let us know, but I guess, how do you decide, like, what, as a lender, what are you looking at? Somebody's credit history, their income, maybe their debt to income ratio. Somebody asked a question, will a lender really let us borrow $200,000 over 4 years? Like, what are the things that lenders are looking at to determine how much are you really going to let somebody borrow from you?
It's really a variety of factors. So income is certainly one aspect. And it's a variety of factors and it depends on the lender. So it could be as simple as your FICO score. It could be your income. It could also be other attributes on your credit report. So how many different types of trades do you have? What's the length of your credit history? So do you only have 3 years of credit history or do you have 30 years of credit history? And then, what's your behavior patterns? What's your payment behavior patterns on all of that, anything that you do have on your credit bureau? So it's really a combination of factors and any and all of that history that you've built up on your credit report, as well as your income is going to be a key piece.
And I guess something else that parents should think about, we mentioned earlier, doing a 4-year plan to really look at 4 years of how you're going to pay for college, not just the first year. The other thing is, if you're borrowing, you also need to look at, quite honestly, if you have another child coming up, and what the time difference is between that next child and if you'll have to be borrowing for that child as well, because that's when it starts to really pile up a little, and you just need to be very careful about what you're doing from child to child.
That's right. The thing I will add there too that I think is relevant, especially as you're planning for multiple years, you're planning for multiple children, particularly if it is the parents co-signing. Just I'm using that as the example again because it's just a really common one. You may want to think about who is mom co-signing for, who is dad co-signing for, to just try to think about that big picture and all of these moving parts. I know somebody asked, I think, if you're married, are you naturally both on the hook for the loan? And no, it's really whichever one of you applies with the student, that's who is taking legal responsibility for the loan with the student. So we do see families do that sometimes where they switch on and off, or one parent takes one kid and one parent takes another, from a co-signing perspective.
Okay, let's talk about, because I know that I saw they're starting to get questions about when can you start to repay a loan. So there's all these other features now related to private loans. So you talked a little bit about the cosigner and the cosigner release and the importance of really understanding those requirements, because it might, and it is actually very likely does vary lender to lender. But maybe talk a little bit about interest rates, what your options are there, and then move on to the repayment options. Sure. and the loan terms.
The one thing I'll just quickly underline on cosigner release, and then I'll move on from that one, is just whatever rules that you get from the lender, just make sure that you are clear on what they are. Sometimes it will just be a rule that says, well, they'll review it and determine whether or not they'll release the cosigner, but they won't tell you what their criteria is. So make sure that what you ideally want is very clear criteria, so you know whether or not you have met those things or whether or not you're going to be able to meet those things. And
if you want to quote college avs, but what's an example of like a detailed requirements? Like, isn't it like having like 24 months of positive payments, right? Or being employed for a certain number of months?
Yes, it can be income requirements. It could be, positive credit history, to your point, positive payment history for some window of time. It could be some period of time has elapsed on the loan. But what can be risky is if you see something that just says that it's at the lender's discretion, because you have no control over that and you don't know what their criteria is. So it's where I would just caution you, if it's at lender's discretion, it's just very hard to understand whether you're going to qualify. Look for clear rules that you can understand how you could follow them.
Okay, makes sense.
So the interest rate is essentially the cost of borrowing money. And you're going to see a range, obviously, when you shop. And again, that's why I recommend pre-qualifying, because you can at least get a tighter range from lenders who offer pre-qualification, so you have a better sense of where you fall.
What about,
yes.
Variable versus fixed?
Yes, variable versus fixed. So variable interest rates are going to move with a market index. LIBOR used to be the one that we always quoted. LIBOR has been retired, so you may hear SOFR now. But what it really means is that there's an index every month that is going to shift the rate up or down. Fixed rates are not going to change over time. That's going to be your interest rate for the entire time that you have the loan. The lender actually is taking on more risk when they make a fixed rate loan, because the lender has costs as well, costs to lend this money to borrowers. And if that loan can't adjust with the current market, they have to account for that by essentially charging a premium for the fixed rate. So what you will usually see when you're shopping for these two things is that variable rates at any given time are going to start lower than the fixed rates that are available at that given time. And what you have to weigh is, how long do you intend to keep the loan? How large is the loan? And what is the likelihood that the variable rate is going to increase enough that it would overcome that difference and make it more expensive than the fixed rate, as well as what your tolerance is for change. So some people would just prefer to know, this is the rate, this is the monthly payment, it's never going to change, I'm more comfortable with that. So it's a personal decision between whether variable or fixed fits your situation better.
Is it possible to start off like if I started off with my loan being variable, and then the following year, like change that to make it fixed?
So if you're coming back for another loan, so let's say you took a variable, you took freshman year, you decided to take variable, and sophomore year, when you come back in to get your next loan, you could certainly elect to go to a fixed rate at that time. That freshman year loan that you started at a variable rate, you would probably need to refinance it. You can't typically go and just change that existing loan.
Okay, that makes sense. But you can have, different loans, taking one being fixed, one being variable. You just can't switch
Yes.
on where you started.
That's right.
Okay, so are there any ways of getting discounts?
There are. So it is fairly common that you can get an interest rate discount for automatic debit payments. So if you sign up to make your payments automatically through the lender, first of all, your payments are being made on time. So it's a great way to build that positive credit history. And you'll usually get something like a 0.25% interest rate deduction while you are having those automatic payments made. That's true on the federal program. It's fairly common on the private lender side as well. Again, can differ on the private side because every lender gets to make their own rules. But but that's very common that you can get that interest rate discount for automatic payments. And then in addition, so on the college app side, this is where I'll go a little bit more specifically about our programs. We have quite a few options on our loan that you can make your own choices about when you start paying the loan back. If you do choose to start making payments during school, how much you pay each month during school, and then how long you choose to take the loan back. So you can choose to take 5, 8, 10, or 15 years on our undergraduate loans to pay that loan back. And if you select a shorter term, so if you say I'm going to pay back in 8 years instead of 15, or if you choose to make in-school payments, let's say you choose to pay the interest while you go in school, you're going to get a lower interest rate by making those choices than you would if you say, I want to take 15 years and I want to defer the loan and not make any payments on the loan until the student leaves school. There's nothing wrong with those choices. Sometimes that's the right choice for people. But if the interest rate is a significant motivator for you, then that is a way that you can lower your interest rate by making different choices about how quickly you repay and when you begin repaying.
And so I like to also explain it to people, all those choices that you just described. The faster you're choosing to pay back, your loan, quite honestly, it limits the risk of a lender. So that's why you tend to see better rates, right? If you're taking out, if you're willing to repay the loan immediately, start repaying immediately, and you have the shortest loan terms. So it's just a business sense. You've just kind of reduced the risk that your possibility of paying back your loan. It looks like you're very highly going to pay back the loan the faster you're willing to do it.
And really the way that we look at it too is that it's in your best interest. It's in your best interest to start, if you can make small payments during school, it is in your best interest for many reasons to get into that habit, to eliminate some of the accruing interest or possibly all of it. It's going to be better for the consumer if they can make those choices. And so we would love to pass that reward along. To your point, Debbie, we have the ability to do that. And so we want to pass that along to encourage people that if that's something that they can do, to encourage them to make those choices.
So if I choose to start repaying immediately, are there different choices about how I can repay? So can I choose to say, I want to just pay $25 a month because I know I can handle that. It may not be the actual payment, amount, but so what are those different options?
So we have three, I'll call it set choices. And then I'll talk a little bit about, you do always have the flexibility. Like I said, there's no prepayment penalty. So you always have the flexibility to pay more when you can. But sort of the defined options that we have one that's a $25 payment during school. Again, it gets you into that payment behavior, and it is reducing that interest that's accruing. The next option, which is typically, depending on the loan amount, it's typically a bit more expensive than $25 a month, is to cover just the interest while the student is in school. So you know that you leave school without any accrued interest. And then the third option for in-school payments would be to start making full principal and interest payments immediately. But then we do also offer that choice to defer. So if the family and the student need to just wait until the student's done school to start paying, deferment is an option.
So there's a question here, somebody asking, can they choose to defer when their student is in school, but make payments just to reduce the principal?
Yes, absolutely.
Okay, and then what are the options about how long somebody can choose to pay back the loan? Like, what's the shortest and what's the longest?
5 is the shortest, 15 is the longest. On our undergraduate products, there are some specialty products in the graduate space that offer longer terms, but for our undergraduates, it's 5 to 15.
And if I chose 5 and I was able to pay it off sooner than 5?
No penalty.
Okay, great. Okay, we just talked about the prepayment penalties. Okay, what about, unfortunately, if there are some sort of, hardships that the student or the family faces?
Yeah, so this is what we always tell people if they're having trouble making payments is just don't ignore the problem. The worst thing you can do is ignore the problem, because really every lender wants you to be successful. It's not in anybody's interest, quite frankly, for you not to succeed. It doesn't help us. It doesn't help you. It's not good for anyone. So there are absolutely programs available. There's a variety of them. It could be extending your grace period to give you more time to get a job after school. It could be giving you a lower monthly payment that then steps up to your full monthly payment. It could be, a hardship forbearance where you really say, okay, we're going to give you 3 months where you don't have to make any payments. So there are a variety of options. It really depends on what the individual specific situation is and what's actually going to be a meaningful solution for them that's going to help them and not unnecessarily add to the cost of the loan. So we really want to work with people on an individual basis to find the right answer, but there are lots of choices available. The other thing I'll just mention, it's not listed on this page, but it does come up sometimes around loan forgiveness. And forgiveness is more common, and that's like public service forgiveness. The programs that are available, that have been available, that are out there right now, that's more common on the federal side. But I will say that for death or permanent disability of the student will also result in forgiveness of a private loan. So sometimes that matters to people.
Is that for all lenders, or you just, that for College Ave?
It's for College Ave, but it is common in the space. It's always one of those things, double check it if it matters to you, but it is reasonably common in the space.
And, again, with everything we're talking about, looking at the 4 years of how you're going to pay for college, it's also important to look at what your monthly costs are. And maybe, Angela, you can talk a little bit about the different like factors that you talked about, when you're going to start to repay, how long you're going to take to repay, how that may impact the monthly costs.
The reason that we offer all of these choices that we offer is so that you can dial in on sort of two factors. One is that the overall cost, and of course, everybody wants that overall cost to be as low as it possibly can be. The way to make it as low as it possibly can be would be to say, I'm going to start paying principal and interest immediately, and I'm going to pay this back in 5 years. And sometimes that's just not practical for your monthly budget. You certainly, I'm sure anybody would love to do that if they have to borrow, because that's going to cost you the least, but sometimes it's just not practical. And so really what all of these different dials enable you to do is get to a monthly payment that you can live with. And then hopefully that is the lowest total cost that is going to be practical for you, because it has to meet both needs. You have to be able to make those payments on a monthly basis.
And can you change any of these dials? Like, I mean, you're deciding, on the loan and all of these features in freshman year, and maybe when they graduate, things change. At that point, can you change, how long, if you're starting at 5 years and you needed to go to 7 years, or those types of things?
So that's where we would need to, it would get into, if you're having trouble making payments on your loan, let's talk about what changes you need to have. So I wouldn't say never, but you do want to try to make the best decision up front. And you can consider things like, what is your student's major? And then what is the typical earning curve on that major? So what can they expect to be earning? Will they need to do some type of program that may say that for the first few years out of school, their earnings are going to be lower, but then perhaps they'll jump up significantly. There are just very different career trajectories that people can take depending on what they're studying. So that is a good thing to think about a little bit up front, so that you can try to make the best decision you can about what that monthly payment will be. And then if you get there and you need help, then we'll certainly talk to everyone on an individual basis and make sure that they can be successful.
There's a question here about if a student goes to grad school, does that extend the start date of when the undergraduate loans need to be paid back?
It does. So as long as you're still enrolled, it can extend that deferment period because you are technically still in school. The one thing I will caution is that it is adding to the cost of the loan. So yes, you can, but make sure you understand what the implications are. And if there is any way that you can start to pay back, maybe even if it's not full payments, but you can start to make payments, it's really a great idea, so that you don't leave school with as much debt.
Right, because even though you're able to continue to defer it, the interest is still accumulating.
That's exactly right.
Okay, so let's go on to, which is a reasonable question about just timelines. When should people be starting to do all of this? How long does it take to process the loan? Understandably, people haven't even gotten their bills yet. So they don't, scarily enough, don't really even know what the final cost of their college is going to be, because, and that's a whole nother discussion, colleges are still raising or changing what tuition is going to be for next year. So you don't know what the final cost is. When should people be starting to do all of this work?
Yes. So what I usually tell people is, as soon as you know how much you need, then you could begin to apply. But the reality is that you don't usually know how much you need until you get into that 30 or 45 day window in the middle. So if you go back to 60 to 90 days, this is the right time to be investigating all of the different providers, to be exploring PLUS versus private loans, to be determining,
do your 4-year plan, do
your 4-year plan.
Yeah.
Check your credit, make sure that you know what your credit, profile looks like. Make sure you don't have any errors on your credit report. This is sort of the pre-shopping phase, get everything ready. And then try to get a sense of, if there are specific features that are important to you, like I talked about our in-school repayment options, or the different terms you can choose, or cosigner release, or any of these other aspects. Figure out what's important to you, and then narrow down your list of which of the private lenders, assuming that you get to that point that that's going to be the right answer for you. Narrow it down to who you think your providers are, and then really within 30 to 45 days of that due date is when you want to try to be applying for the loan. And you can typically, with College Ebb, you can come in and you can get approved typically in session. You can fill out a form, 3 minutes later, know whether you're going to be approved for the loan. What adds time to the process is what I described, that once we've approved you for the loan and you've said, yes, I want these, I accept your terms, I would like to take this loan, we have to communicate with the school. And the school is going to certify, yes, Debbie is a student here. Debbie still needs this money. All of her costs are not covered. Yes, Debbie is making satisfactory academic progress if she's not a freshman. The school is going to certify these things and then send back to us the confirmation that we're able to make this loan. And they're also going to tell us how they want the money sent and when they want the money sent. So what will typically happen is, right now you guys are in the perfect phase to be in shopping mode. And then when we usually start to see many of the applications come in or in maybe early July, as those tuition bills are hitting mailboxes, usually that week after 4th of July, as they're hitting mailboxes, we start to see that volume pick up. And then the schools usually ask for the money roughly like first week of September is usually actually when they want us to send the money out the door. So the reason I call that last piece out is because don't be too paranoid if you probably moved your child into the dorms and the money technically may not be at the school yet. And that's because the school has told us they don't want it yet. And your lender will typically communicate with you through that whole process.
So there was a question, but just to reiterate, that somebody asked, are these the days before they move in or the days before the bill comes or the bill is due?
I would say before the bill is due, before your due date.
And another good question is about when people are applying for a loan. Well, there's two questions. One is, do they have to apply now? Like, what if they feel like they have the first half of the semester, they have the first semester, under their belt? Can they apply in the middle of the year? And then the second is, I guess, similar, but if somebody does need money for the whole year, are they applying for one loan that's going to cover the full year amount?
Yes. So let's start with full year, and then I think it's probably going to naturally answer the other questions. So when you go in to apply for the loan, it's going to ask you what academic period you're covering. And then usually you'll see choices like, I'm trying to pay for just fall of 2022. I'm trying to pay for fall of 22 and spring of 23. And you can decide whether you're going to borrow on an individual semester basis or for that full academic year. If you choose to borrow for the full academic year, it doesn't mean that we're going to send all of the money up front. What usually will happen if you say I'm borrowing for fall and spring and you're applying, in July and you're paying for fall and spring, the school will come back and say, okay, I want half of the money in September and then send us the second half of the money in January. And the important thing to understand there is you're not being charged interest on any money that hasn't gone to the school. So you're only going to be charged interest on the portion that goes to the school when it goes to the school. So sometimes people worry that they'd be overpaying and they think they need to go semester by semester because they're worried about paying interest on money they didn't need yet. And you won't, because of the way that the process is naturally set up.
Okay. I'm going to scroll back because there were some questions really earlier on that I thought were a little interesting. And one, and this we don't really normally touch on, but one was related to somebody asked that they're foreign. And so they don't, the FAFSA doesn't apply to them, but they need to take out loans. Does anything we talk tonight be helpful for international students?
So some international students are eligible for private loans. That can be harder to find depending on the situation. It certainly is a little bit potentially more difficult.
Got some more.
Oops, sorry. Go ahead.
But for example, so College Ave, we do lend to international borrowers. We do require that they have a social security number and they do need a US-based cosigner. So if you are an international student, you are going to want to shop around and you're going to want to understand what your situation and your options are, because you may find different requirements like that, depending on which lender you're going to. But certainly there are private lenders that lend to international students.
Okay. And then somebody is asking, does a student's major factor into the evaluation for a private loan and potentially the interest rates? Because, you talked about, the salary trajectory and after graduation.
I'm not going to say never, but not typically. And particularly as far as interest rate is concerned, it's really more about what your current credit profile is, what you look like today is really what that pricing is going to be based off of.
And another question here that somebody is saying, that they potentially know that they have to borrow $120,000 over 4 years. Can they ask for that all at once, or do they do it, year by year?
You come back and ask for it year by year. And I know there was one other question too around, let's say that you do borrow for the full academic year, and then something changes between the fall semester and the spring semester. The school can change. So let's just say that the student, worst case, they drop out, but let's just say that their course load changes and they don't need as much money. The school can change the loan amount. So you're not committed to that second dollar amount. Changes can still be made before that money goes to the school for the spring semester.
Another question about this parent wondering if they could potentially be approved even though a co-signer has a bankruptcy in their history.
So I won't say that there are no lenders that do that. There may be lenders out there that will lend with a bankruptcy on file. It's going to be more restricted. Bankruptcy will be much more difficult in the private space to find a lender that will accept that on the file.
Okay, let's just see what else we can. Oh, okay, this is interesting. If you co-sign for your student, how much, this is the parent asking, how much will this affect your own credit score? And if you potentially need to go borrow for a car in the future? So
there's no perfect formula for me to tell you exactly how it will affect your credit score. But it will affect your credit score. It could help it if it is, if there's positive payment activity on there, and if you have the income to support that loan. It could hurt if you're trying to then apply for another loan and you don't have the income that is sufficient, what we call kind of debt to income, that ratio, and you're trying to apply for a loan and you don't have the income that would support both of those loans. Or if there is a negative history, if the student, maybe you're relying on the student to make those payments and the student isn't making payments, it's going to hurt your credit score. So it can hurt, it can help. It's really so individually dependent. The important thing is to recognize that it's going to be on your credit report and it will impact your credit report.
So there's another question here about a parent basically saying they know how much they're really going to have to pay, but they're not quite sure how much to borrow because it sounds like they're figuring out that they might be able to cash flow some additional funds, but they know that they're still going to have to borrow. So can they borrow, a dollar amount that they come up with, but then what if they end up not needing that full amount, because they can cash flow more of it than they planned? So,
again, there's no penalty. So there's a few different scenarios there. If they've already taken the funds, so the money's already out the door, they could certainly just choose to turn around and send that money back, essentially as a payment. If the money hasn't gone out to the school yet, they could contact the school and they could have the loan amount reduced. So it really just depends on where the loan is in the process. But again, because there's no prepayment penalty, it's fairly flexible. I think that would be much more of a concern on a loan where you're worried that if you suddenly don't need that money and you pay back faster than you originally said you would, you're going to pay a fee, is where I think that would come into play more.
Can you talk a little bit about what do you guys consider excellent credit? And is there kind of a low point, of people having certain credit below a certain amount, which they're just probably not likely to get approved?
Yeah. So I will tell you that our system is more than just FICO based. So just take this as sort of a loose, we're looking at more than just that. But I think a good general rule for people is probably if you're in the mid 600s, that's probably about as low as you're going to be able to go from a credit score perspective. And that's not guaranteeing that everyone in the mid 600s will get approved, but that's sort of a good watermark, I would say, for the minimum that you need to probably be shopping in the private market. And then obviously that goes up to 850. So as you increment up, it will become easier to access the loans.
Okay, wow, it's almost an hour and 45 minutes. Yeah, no, an
Wow.
hour and 50 minutes, hour and
Oh.
50 minutes, yeah. But still, I think we kind of covered a lot of important topics, and I'm just going to reiterate what I said at the beginning. We will send out a link to the recording so you can watch this again, if you want to kind of scroll to certain sections to understand it better, and we will send out a summary sheet, which we're calling tip sheets, really of like the most important comments that we mentioned tonight that you should be aware of, and this, and also kind of a list of questions that you should be thinking about as you're shopping around and looking at loans from different lenders. So thank you as always, Angela, and thanks everybody for starting to learn this. It's another kind of final phase of the process, but we will all get through it together.
Yes, thank you, Debbie. It was wonderful to be here as always.
Thank you. Thanks, everybody. See you soon.
Night.